I'm Gary Venner, Managing Director of IFA Acquisitions, and I'm joined by Marais, Director of Vertus Capital, where we continue our informative question and answer series on our YouTube channel to provide insights into helping buyers and sellers understand the benefits of using brokers for the sale of their IFA businesses. The title of the next video is coming up on screen now. So Matt, tell us, who are Vertus Capital?
So Gary, we are a small niche business set up in 2016 by myself and some others with the focus specifically on providing independent capital to the UK IFA market. So all we do is help deals get done between IFAs.
So Matt, you talked about independent capital. What is independent capital and how does that work?
So Gary, in the UK market, there is a lot of capital coming into the IFA sector specifically. What we find is that a lot of that capital has hooks in it. So it's either private equity funded consolidators that are looking at doing a large series of acquisitions, but they have consolidation, they have equity, they have certain requirements that come attached to that capital. What we were looking to do is to say we would like to bring capital that doesn't have hooks. It's priced as a standalone finance facility, and the purpose of that is to enable something to take place. In our case, it's acquisitions or MBOs, and really what the clients of that money would get some comfort on is that the capital they're taking doesn't impede the way they wish to continue running the business. So we don't mandate or want to see large migrations of client proposition. We don't want to see a huge amount of attrition or shakedown or change happening in the businesses that we're funding. In fact, we look for the opposite. So independent more speaks to there's a price for the capital, it's clearly structured as a debt facility, and the borrowers of the money don't need to overhaul the way the business works, they don't need to behave in a different way. And most importantly, they can continue to focus on their primary function, which is looking after the financial planning for their clients.
And I think that's fantastic, Matt, that your deal is non-contingent on making any changes, which is great.
Yeah, we find that that tends to end up with better client outcomes, better deal outcomes, and ultimately, while there are some pros to the consolidation that's happening in the market, the vertical integration, we find that in many instances the needs of shareholders are put ahead of the needs of clients. And so by firms raising independent capital for a specific purpose, we can quote a specific price for that, and we can say that enables a specific deal, ultimately with continuity in mind.
So Matt, of all the sectors that there are, why has Vertus Capital chosen to offer finance to financial advisory businesses?
So there's a number of reasons for that. The first is, in my background, I've been a financial advisor, so it is a sector I have some awareness of. I think what we find is the IFA market in the UK struggles to raise debt finance from the major finance institutions, for example, high street banks and general credit providers, because they don't understand how these businesses work. Realistically, most of the high street banks would focus their financing on hard security, whereas you need to understand how these businesses work in order to be able to successfully provide finance to them. And that's where we feel we understand the 100 small things you need to understand about the IFA sector to successfully provide finance to that market. So we find once you understand those 100 things, it's a great sector for providing loans to, because they have demonstrable track record, it's steady, predictable, it's a very client-centric industry, and so the clients, very rarely is there a mass move of clients from a specific advisor. There's good data in the market, so with the use of platforms, financial information, because it's a regulated space, there's quite a lot there that helps provide a pretty clear credit profile. And we find that there's a very good platform in that space to actually provide credit to that sector.
Well, this is really refreshing to hear, and you may not know this, but I'm originally a banker, and using good canons of lending, which is what you're actually doing here, and especially with not just the firm that's doing the acquisition, but also understanding the business that's being purchased, is absolutely very refreshing to hear that there's somebody in the market available to finance these deals.
Yeah, and we feel that it's enough of a sector to provide as a niche focus just that. And there's so much opportunity to provide it throughout the UK IFA market that we're very excited about the prospects and enabling healthy, constructive consolidation to take place in the UK.
So Matt, what type of deals are you mostly involved with?
So we will focus on any IFA succession opportunity. People have different terms and terminology for it, but realistically what it would mostly translate to is firms looking at doing an acquisition. So there might be a single tactical acquisition that they have in mind with a regional firm that they have a relationship with. It might be firms that are looking at doing a number of acquisitions in a specific area, so they have a strategy for multiple acquisitions. It could be share purchases or client bank purchases. And one of the products we're very excited about is MBOs, because we feel that MBOs are a potentially great avenue for firms to look at succession planning. And so we'll fund what we call single acquisition, multi-acquisition of client bank or shares, and then MBO transitions.
Matt, what options does a business have when needing to grow, and how does Vertus fit into that?
So Gary, a IFA that's looking at growth has a number of options. The most obvious one is to self-fund that growth, so to wait and just slowly grow through self-generated cash. The problem with that is that it takes a long time. The joy of that is it's the easiest option in the sense of there's no risk involved and you can just kind of stay the course. There is an opportunity right now in the IFA market with the consolidation that's happening for firms to compress time using external capital. And what we see firm owners doing in that space is raising equity capital. Now they could go to a privately funded office, they could go to a private equity firm. That's obviously an option, but typically what that will involve at some stage is giving up control over the business. If not now, pretty soon in the future. And that's something that many owners are not keen on doing. Alternative to that, they could partner with the major vertically integrated corporate. Same thing, the control questions just around the corner. And also very often all those forms of capital will have an implication on how the firm owner runs the firm. What are they required to do? What's the advice proposition? What products can they advise, etc., etc. And for many owners, that's a problem. They want to grow, they see the opportunity, but they don't really want to do it in such a way where they feel they have to sell out or give up control. That takes them to a point of debt. Debt is helpful because once you've repaid the debt provider's gone and you have all the shares. Very nice. However, obviously with debt, there's some hooks and requirements, there's covenants, there's things that have to be kept in check along the way. And for many firm owners, that's a concern. They don't know how that looks or how that works. As a debt provider, you're not really a partner. You're providing a product, capital, and you're looking for a repayment. And so what we try and do is we've tried to build a debt product that aligns very specifically with the way in which IFA businesses grow. So yes, for a lot of firms, they could probably look at raising that capital externally. It's difficult to find, but they can. But what we've tried to say is, let's focus just on this niche of IFAs, help them compress time by bringing debt to enable them to do 1, 2, or multiple acquisitions. And ideally, we'd like to partner with them through that growth journey until they've fulfilled their specific aspirations. Some owners want to do 1 deal and sell in a year. Some owners would like to do 10 deals, and they all have a different journey that they're trying to walk. What we try and do is enable that. By building a product that's focused specifically on IFA deals, it helps for them to grow and develop that business compellingly without needing to give up control at what we feel is a fair price in such a way that provides them with a really good commercial return. So there's a good incentive for them to go and do those deals using debt, knowing that at the end of the cycle, they've paid off the debt, the businesses where they want it to be, and they can then explore their own succession options at the end of that.
And I can see why a business would want to do that and to keep that control. Does that cause an issue, though, for those businesses by raising debt finance with regards to capital adequacy and reporting to the FCA?
So it's a good question. What we obviously can't advise on those matters, so what we tell our clients to do is actively take advice to make sure that your structure is correct and that you put this thing together correctly. But what we typically find is that firms will do the capital raising in a separate part of the group, so that they're enabled to protect the IFA affairs where the clients are advised and the FCA has a legitimate concern around capital adequacy and continuity, is to do the capital raising in a separate vehicle. So for most firms, they would use a holding company or another company that they own to raise the debt. And obviously we're very cognizant of those requirements. So built into the way in which we provide the finance is an allowance for the fact that you should, as an IFA, be much more concerned about the regulator and protecting your clients as part of the regulatory framework than just raising debt. And so we've made sure that we've structured our product to work around those in a way that's constructive for everyone.
And I think that's really good to hear again, because I think sometimes on the mainstream high street lenders forget that fact, and especially when advancing the monies to a holding company as opposed to the trading entity. So it's really great to hear that you're involved in those debt deals and will structure it accordingly.
Yeah, we find that in niche specialized areas like the IFA sector, financial planning, you need someone that understands the 100 small things about how that business works, so that in providing the debt, you're not actually obstructing how the business operates. And so what we've been able to do is to build a product that allows firms to go out and grow and develop their businesses, look after their clients, where the debt isn't impeding the way they run the business.
Make sure that you subscribe to our YouTube channel and switch on notifications so that you won't miss our next video in this series.